Once you understand, how do banks make money? It's easy to delve into the income statement. Income statement of bank differs slightly from traditional companies. In this session, I will explain how do income statement look for a bank? How to analyze income statement using schedule. Here, I will show you income statement of HDFC Bank from March 2021 annual report. The first line on income statement is always income, which is subdivided into two distinct lines. First, interest earned. This refers to the interest collected from lending capital to the individual and companies. Second line under income is other income. The next line item is expenditure. Bank's main expense is interest paid on borrowed money. There are other expense line items like operating expenses, provisions, and contingency. I will talk about each line in detail shortly. The next line is profit for the year or net profit. The net profit is calculated as total income minus expenses including taxes. The next line is appropriations. Appropriation is setting aside money for a specific purpose. You can consider as budget-making process where money is reserved for various purpose like paying dividend to shareholders, transferring amount to various reserve to meet future obligations and so on. After appropriations, you will see earnings per share. Net profit is divided by number of outstanding shares to get the earnings per share. Typically, you will notice these line items on every income statement for bank. I hope you noticed column with heading schedule. The main purpose of schedule to the financial statement is to further clarify breakup of each line item. Alright, it's time to go over each line item deeper to develop good understanding of bank's income statement. As you know, income is reported under two separate lines. First, interest earned. Second, other income. Let's talk about interest earned. Bank lends money to the individual and companies at certain interest rate. Interest collected from borrowers is classified as interest earned. Schedule 13 provide details of interest earned. You would have noticed, there are several sources of interest earned. Let's start with interest or discount on advances or bills. This is the interest income earned on loans given to the customers. The customers can be a retail like individual people borrowing money for home loan, personal loan, vehicle loan and so on. The other category is wholesale loan. This refers to the loan provided to corporate. Moving on to the next line, income on investment. Just like individual, bank invest surplus money with the expectation to seek higher return in future. Income on investment refers to the dividend on units of mutual funds, equity, preferred shares and so on. Next line item is interest on balance with RBI and other interbank funds. Banks must keep certain percentage of their cash with RBI. Also, bank can lend money to the other bank. This specific line refers to the interest earned on deposits with RBI or funds provided to other banks. The last line item under interest earned is others. Banks can raise money or deploy money for short term. This includes interest earned on such short-term activities. Now it's time to review the other income. You can review Schedule 14 to seek greater clarity on sources of other income. Other income is generated through activities apart from bank's core business. It includes income generated by various sources like income earned through commissions and intermediary bank fee, profit on sale of various investments owned until maturity, sale of properties and so on. Revaluation refers to the increase or decrease in value of the assets based on estimates of market fair value. It also includes revenue generated through sale of building and other assets. Let's quickly go over remaining lines. Exchange or derivative transactions. This refers to net profit or loss due to trading activities like futures and options. Dividend from subsidiaries. This income is received as dividends from subsidiaries, joint ventures and so on. Lastly, miscellaneous income. This refers to the income due to any other sources like lease income and so on. Now, it's time to summarize the total income. It is the sum of interest earned and other income. Interest earned is the income generated from core business activities of lending the money. The other income includes income from sources that are other than company's core activities. The bank has income doesn't mean it is making a profit. To determine if bank is making a profit, you need to deduct the expenses from total income. On the income statement, right under the line for total income, comes the expenditure. Let's review expenditure side of income statement. Bank generally classify their expenses into few line items. You will see similar line items for all banks under expense category. It starts with interest expended. This expense is associated with the interest paid by bank for borrowing money. In previous section, I talked about bank generate capital from various sources. It includes deposits by people and companies, borrows from central bank like RBI and so on. This line refers to the interest paid to deposit account holder. The deposit could be in form of fixed deposit, current and savings account deposit. Deposit under current and savings account is called as CASA deposit. CASA deposit is the cheapest source of money available for bank since they pay very minimum rate of interest to account holder. Growing CASA deposit is always a good sign for bank. Bank can also borrow money from RBI or other banks. This also includes expense associated with interest paid to RBI or other banks for borrowing money. Then comes the operating expenses. Operating expense is the expense bank incurs to run its normal business operations. It includes expenses like employee salary, bank's property, rent, insurance, repair, maintenance and so on. You can further review breakup of expenses under Schedule 15 and 16. The next important line item is provisions and contingencies. This expense is associated with the loans that are in default or likely to be default. Provisions and contingencies are very important expense line to review for bank. Let's review Schedule 24 to understand the details. In annual report, the breakup of provisions and contingencies is provided under Schedule 24. Don't get confused with the actual numbers. In income statement, numbers are in thousands. However, these numbers are in crore. The first line is provision for income tax. This is the estimated tax company expect to pay in the current year. The next several lines talks about provisions and contingencies. Let's understand difference between provision and contingency. Starting with provisions. This expense is for potential loan defaults. Individual people and corporate default on loan due to various reasons. If individual or corporate get defaulted on loan, bank still need to pay back to its depositors and any other sources form where bank borrowed the money. In other words, bank will absorb loan default as loss and add it under expense bucket from accounting perspective. Please note, this is very important expense to review when you analyze bank for investing. The provision refers to the amount set aside for uncollected loans. The next line is contingencies. Managing risk is very important in banking. Banks set aside some fund for various reasons like loan loss that might happen in future. Provision and contingency expenses are evaluated as per guidelines provided by RBI. The expenses associated with provisions and contingencies are called as non-performing assets. This is also referred as NPA. In banking business, growing income is preferred only when bank can keep NPA low. Let's summarize the income statement again. It starts with income. Income has two distinct line items, interest earned and the other income. The next line item is expenditure. Expense has three main line items: interest expended, operating expenses, provisions and contingencies. The expenses associated with provisions and contingencies are called as non-performing assets. This is also referred as NPA. Next line item is net profit for the year. It is calculated as total income minus expenses. The last line on the income statement is earnings per share. It is calculated as net profit divided by shares outstanding. The important thing to remember: line items in bank's income statement will have an associated schedule. You can review schedule in annual report to seek greater clarity on each line item. I hope you are in much better situation now to read income statement for bank or financial companies. Thank you.